All right, today's Wednesday, and this is a mid-market day commentary. We're going to just take a look at the patterns that are developing on our three indexes. I'm starting with SPX today. As we usually do, we've seen the cycles up and cycles down, and we're usually entertained by both of those every day. It's always amazing to me the number of people that will describe the market as this, this market just continues to go higher and it won't stop, or this market just continues to go lower and it won't stop. Even if you rewind back to some more dramatic movements in the market, like 2008, you're going to find as you drill into intraday detail that there are cycles up and there are cycles down, and we've had that today. So what I'm sharing with you here is a 20-day time period, but I'm showing 10-minute detail. So if I zoom in a little bit, you can see here what the activity has been today. We cycled higher. We stalled out right around this area. I'm going to come back and talk about that in just a minute. And then we cycled lower, and right now we are in a cycle movement higher. So if I just want to see what that range of movement is, I can go off of today's high. Oops. Let me just do this differently here. I can come off of today's high. And then hit today's low. And you can see here that the range of movement's about 12 points on SPX. Now, the way we trade at Options Moneymaker and in the live trading room, a 12-point move is enough for us to take a profit. What we're doing is we're opening long calls or long puts depending on the directional bias of the signal that we see on our Able Trend charts. And then we are either closing that out for a profit as a day trade, or we are legging into a spread and we have a favorable cost basis on the spread. Sometimes it's a credit on a long vertical spread, which when you have a credit on a long vertical spread, it just means that you cannot possibly lose on that trade. But these cycles allow us to take advantage of directional bias trades, whether it be to the upside or to the downside. Now I want to come back and I want to talk about this area of resistance right here, where we moved right up to this declining line of resistance. And there's a terminology that I use quite often that is a natural level of resistance, or I might use the terminology natural level of support. And I've received several questions about exactly what that means, so I'm going to give you that definition, a little education here. When traders are first starting out in particular, or first starting out with learning how to do a technical analysis, identifying where resistance and support should be placed on a chart is and can be very difficult because it seems rather arbitrary. I could draw my lines until I'm happy, and define whatever pattern I want. Well, that's true, but that doesn't really help you at all. What we know and understand from over 30 years of trading is that the indexes move in cycles, and they have a tendency to have a trend. So this pattern was a rising trend, and within that trend, they have a tendency to move down to a reasonably similar level of support and to move up to a reasonably similar level of resistance. So how do you define where that level of support or resistance is? When I say a natural level of resistance, that does not mean because I have arbitrarily drawn a line on my chart. What that means is that at some point in the price activity on the index, the price moved up to a certain level. And so I'm going to zero in here on this particular price bar right here. For those of you in the live trading room who are following along with the Able Trend charts, by the way, we just got a 5-minute buy signal on NDX, so that's indication that we may see some continuation to the upside here. All right, so let's look at this price bar right here. Let's see if I can zoom in a little bit more on that. Right here, this price bar. The high of that price bar, this is a 10-minute price bar, is higher than all of the price bars leading up to it. It's a higher high. It's also higher than the price bars that formed after it. So what that tells me is that the market in the activity of SPX trading, the market has formed a natural level of resistance, meaning everything before it and everything after it traded lower. Now that doesn't mean that at some point in the future it won't trade higher, but I'll get to that in just a minute. When you have a natural level of resistance form, as this did, what you want to do is to look at that high, and then you want to scan back further in time, and you want to see whether or not there are prior natural levels of resistance that would logically tie to this current natural level of resistance. Now, in my definition of the pattern here on SPX, I went back here because there were two areas where there was a natural level of resistance, one here and then one over here, and both of those tied very nicely to the current natural level of resistance. And so what that tells me is then that the market has defined a certain boundary that it's currently trading within. That doesn't mean that it's going to stay there. It doesn't mean that it won't move higher. But for now, at this point in time, it's helping me understand that there could potentially be a bias to the downside from that natural level of resistance. And that's exactly what we saw today. We saw a move off of that high today on SPX, which was 2099.71, down to a low of 2085.68. That was enough of a movement to take a trade to the downside, an intraday trade to the downside, on either leg into a spread or trade that as a day trade, get in to a long put and exit out of that put as a day trade. When we moved down to the low of the day, and we didn't know that it was going to be at the low of the day when it was forming, but when this price point formed right here, the low at 2085.68, I could see that all of the price activity prior to it was higher. So all of those lows were higher lows. And then after that price point formed, when we started to see the price bars after it form with higher lows, we recognized that as a natural level of support. It moved down to a price, and then the market started to shift and move the price higher. So when you can identify natural levels of resistance and natural levels of support, those are helping you to identify the boundaries of your pattern. Now, I probably am repeating this more often than I need to, but again, that doesn't guarantee that the price activity is going to stay inside that pattern. It gives you a guideline for now, and the longer it stays inside that pattern, the more integrity it has, and the more likely it is to continue in that pattern, and you can trade that. But it also gives you a parameter to identify when we're breaking above or when we're breaking below. If the market, if SPX turned and headed lower right now and came down to support and continued moving lower, I'm going to very quickly, very easily recognize that it's moving below its previous level of support, and it may no longer be that this cycle is valid. So you also want to identify multiple time periods. So here we have this declining pattern, right? That's where we identified the 3 levels of natural level of support, and there's a corresponding parallel line that identifies a natural level of support. So these are natural levels of resistance. I may have said support, sorry. And this is a natural level of support. Within that pattern, there are multiple cycles. moving higher, moving lower, moving higher again. So in the last few days, we had a cycle down, we had a cycle up, and even within that up cycle, there were miniature cycles that were moving up and down. And now we appear to be in a down cycle. But I spend a reasonable amount of time looking at my bar charts on a daily basis and identifying multiple patterns because it more quickly helps me assess where we might be headed. Now, earlier today on SPX, when we hit that natural level of resistance, I had identified a rising cycle previously based on this low and this low, and a parallel resistance was coming across that that price point. So that also told me that we had two levels of resistance potentially at that area of activity. So now that I have that in my thought, and I realize that we could potentially be at two natural levels of resistance on two different time periods, one is a short-term cycle and one's a longer-term channel. When I see a signal to go short on my 3-9-minute Abel trend chart or my 5-15 Abel trend chart, it just has a lot more strength for me, a lot more validity. There are varying degrees of strength of the trade. And you've heard Michael and I discuss many times that there are conservative entries, there are more assertive entries into the trades. When I see a natural level of resistance forming on my bar chart, and then I subsequently see a signal to go short on my Abel trend charts, that gives me confidence to jump into the trade perhaps a little bit more quickly than what I would otherwise if I don't have a frame of reference on the big picture. Let's take a quick look at RUT, and then I'm going to do NDX. Now, RUT, in my opinion, is very clear. Very clear. We are in a declining channel. Today, we hit a natural level of resistance when we came right up to that declining resistance. And I want to say that this channel has not been modified today. It came right up to that natural level of resistance that had previously been identified back on the 20th, and then it ties all the way back to the turning point of the previous rising cycle. And then we have a corresponding natural level of support down here that formed, identifying where our parallel declining support is. Within that channel, that declining channel, there is currently a rising cycle. Now, what I need to assess, and it's important, I think, for every technical chartist, to identify whether this current trading activity belongs inside this rising pattern or whether we're getting an early indication that we may be breaking below this rising pattern. We've already confirmed the declining channel. Now what I want to do is to assess whether or not this cycle right here that sits all inside of that channel, whether that requires a modification. So I'm going to modify it here quickly. And what I'm going to do is I'm going to just very simply pull my level of support down to this natural level of support. Natural level of support, again, is the lowest price, the lowest low on a price bar in a set of price bars. So the reason this is the natural level of support is because all the price bars leading down to it are higher lows, and all the price activity so far leading away from it are also higher lows. So I adjust my resistance down to these two natural levels of resistance where price moved up and then fell away, price moved up again and then fell away. And I think that that's a valid adjustment. That is a small tweaking adjustment to that pattern. And so in my opinion, my interpretation of RUT is that we are still, in fact, validating the declining channel while also validating the rising cycle. And what that does is it forms this wedge pattern right here. And if we moved back higher again and validated resistance, and then moved back lower again and validated support, eventually we're going to get into the tightest part of this wedge, and eventually we will break out to the upside, or we'll break down below support. Let's take a look at NDX. Now, NDX is the index that I pay the most attention to, that I follow the most, and the majority of the trades that I do are on NDX. We've had some nice trades today. Before I get to the chart, we came into today holding a long put that I'd held overnight. I actually opened a new trade today that was a long put on a signal that I identified to go short. And then the index actually moved higher after I opened that new put. And of course, I was still holding the put from overnight. But we used one of our techniques, and that was to cost average by adding an additional contract once we saw that there was a confirmed signal again on our April trend charts to go short. That activity, coupled with patience and confidence that we could manage these trades in by using some of our more advanced management techniques if necessary, that patience won out, and we ended up having a nice profit on both of those trades. Time was on our side on those trades, which is very important, and we exercised patience, applied the discipline of first level of management, which is cost averaging the position. But we don't just arbitrarily cost average. We use our Able Trend 3 9-minute charts, 5 15-minute charts, and we also refer to our 30 90-minute and 61 80-minute charts. So we're taking into account all of these different time periods, what the patterns are showing us, and then we're also keeping in mind what the bar charts are showing us. So we're taking into account all of that information in order to make a decision. And when we see that the consensus of those patterns is that there is a bias to the downside, that was when I pulled the trigger and entered a cost averaging by adding additional contracts to both of those trades. As it turned out, we closed them out both for a profit. Plus, we've had a couple of other trades today that we did that were profitable. So we're sitting here with $1,800 of gains for the day. And what we're doing basically is we're using capital that we were using yesterday. We're recycling capital from yesterday. We had $800 of gains yesterday. So we have taken $2,600 of gains in the last 2 days, and that is all from using the same capital over and over again. Put it into the market, take it back out with a profit. Put it in, maybe take a small loss, or maybe apply some management, but you need to manage your capital very closely, and that's exactly what we do. We don't let these things run away from us. So on NDX, if we look at the chart here, today, just like SPX and RUT, we moved higher, and on this particular price bar, we saw the high move up to 44.42, and all of the bars leading up to it were lower, and all the bars leading away from it were lower. So that becomes our natural level of resistance. So think about this in terms of, you don't have any lines drawn on your chart. You may just be coming to this for the first time, and you're trying to identify where your pattern is, what your parameters are for support and resistance. If I start working backwards, I'm just going to say this bar right here is actually a natural level of resistance because the current bar is a lower high than this one, and the bars prior to it were lower highs. Here's a natural level of support. Now, this is technically a natural level of support also, and so is this one. Although subsequent to that, there was another level of support. But if you're just starting out with your charting and really getting used to how to chart effectively, you can identify each of these patterns. You can identify each of these cycles right here. And you're going to start to get familiar with identifying your rising and declining cycles. So here I identified right in here as natural levels of support, this one actually right here, and this and these 2 points as natural levels of support. So natural level of resistance up here, natural levels of support. There's a declining cycle, there's a rising cycle. So when I first started charting, gosh, over 30 years ago, I would spend a lot of time, of course it was a lot more difficult before we had online brokers, but I used to spend a lot of time going through and identifying as many of the smaller patterns as I could, like this. And then you're going to find that it's a lot easier to recognize the larger patterns because all of these small patterns fit inside of a larger pattern. So if I didn't already have a larger pattern in place, I would now see that this was the bottom and beginning of an up cycle. The next bottom and beginning of an up cycle is over here, right here. And this is the top. So all of those cycles sit inside of that slightly rising channel. So that's just kind of a opportunity for you to have a little clearer understanding of how to identify your patterns. But if we take a step back now and we look at where we're currently trading, see, look at what's happening. We now appear to be breaking below this rising support, which is fine. I'm not married to this as a channel or cycle. This is telling me very quickly that we may be deviating from that pattern as I originally identified it. And that's the type of activity that I will track throughout the day on my bar charts. But as I've said, every single day, I then rely on my Able Trend charts to tell me exactly when to enter a trade. I only want to keep in mind where we're trading relative to kind of the big picture here, but using the signals on the Able Trend charts is absolutely the way you're going to be most successful. So I want to talk a little bit about risk, and I talk about risk a lot. So if you've heard me talk about this before, I should say I apologize, but I don't, because one of the biggest violations that traders make is overextending their capital risk. Let's just say you come to trading and you decide that you're going to put $50,000 in your trading account. A lot of people will tell me how much money they have in their trading account. That means zero to me in terms of understanding what your risk tolerance is. Does that mean that that $50,000 is all the money you have and you've put it in your trading account but you don't want to lose it? Or does that mean that $50,000 is a fraction of your total capital and that's what you're willing to risk? So one person with $50,000 in their account might be willing to risk a maximum of $5,000. And one person with $50,000 in their account might be okay if they lost as much as $50,000. Only you can decide what your risk tolerance is. And we're never going to tell you that. We're never going to tell you what you should trade. We're going to teach you what we trade, and that's up to you to incorporate that into your own personal trading business. But if you have $50,000 in your account, you've decided that's what you are willing to have in your account to trade, you never, ever want to butt up against $50,000 of risk in the market. I don't care how many trades, how many positions you have open. I don't care how many times you might have managed a position or how many times you want to argue or discuss that you had to do something and so it took all of your capital and now you don't have enough capital to do the next step. If you are in a situation where you don't have enough capital to follow the next step, it's too late. You've already violated the very basic rule of trading that you never want to overextend your capital. Every single trading decision you make, whether it be opening a new position or covering an existing position to reduce your risk by turning a long put, for example, into a spread, or managing a position, or adjusting a managed position. Every single trading decision you make must start with how much capital will this trade require? How much capital will the trade require? How much capital will my adjustment require? How much capital will the management of this position require? When you are considering making that move, whether it's a management move or a new trade, you need to know how much it's going to require. And then you need to look at your account. You need to look at the total amount of capital that you have available. And then the third and more critical step is you need to decide for yourself personally, of the capital that you have available, are you willing to and comfortable with risking the amount of capital that this trade will require? Now, there seems to be this phenomenon with traders that they feel like they have to take a certain trade. They have to make an adjustment on a trade. They have to do something. You don't have to do anything. You might be better off taking a loss on the current trade instead of putting additional capital into a trade. There's also an assumption that a lot of traders make that in order to manage something, you need to have, a lot of additional capital in order to manage. That's not always the case either. We've had management adjustments this week in the live trading room that have required some small amounts of capital to be added to the trade, and we've had other management adjustments that have actually been capital positive, where we've taken capital out of the trade as well as profits, and we still have the position in play. So start every trading decision with how much capital is required in order to place this trade, regardless of what kind of trade it is. And decide for yourself personally, is that an amount that I am comfortable putting into this trade, that I am comfortable having at risk relative to my total account, relative to my total capital available? And then you have to make a decision. Is that a trade you're going to make? I will tell you, I've been trading for over 30 years. I review my positions frequently throughout the day, and I very frequently find great ideas, great trade adjustments, great opportunities to reconfigure a position, great opportunities to lock in a huge profit while I'm reconfiguring that position. But I'm not willing to devote the capital. I'm not willing to put the capital required in order to make that trade. So I personally enjoy going through the evaluation process because I think it keeps my skills and awareness sharp as to what the possibilities are. But there's a difference between what the possibility is and what I am now actually going to decide to do. What I choose to do, it might be different than what I could possibly do. And if the trade adjustment on a managed position doesn't look appropriate to me now, it doesn't mean that it won't look appropriate to me tomorrow. Or perhaps I'm not comfortable putting capital in that's required today, but maybe in the next 2, 3, 4 days, I close out of a bunch of other positions. And all of a sudden my capital that's available has grown to a point where now I might be more comfortable putting that capital into that trade that I originally evaluated. So the process of evaluating the charts, the process of evaluating your capital, and the process of evaluating your managed positions, your position adjustment opportunities, is all the art of active trading. This is the art of trading. If you want to be an active trader, to me, an active trader isn't just, I take this trade, I get out for a profit, and I don't do anything else. That's not, in my opinion, what active trading is. You're going to increase the odds, improve the odds of success, and being a successfully profitable trader if you devote some time to looking at and studying your bar chart patterns, looking at and studying the 30, 90-minute able trend signals, the 60, 180-minute able trend signals, and then once you have an awareness to a point where you literally can wake up in the morning and you can visualize where the indexes are trading when you see the overnight futures prices, then you revert back to the ongoing throughout the day monitoring of the 3 9-minute chart and the 5 15-minute chart, looking for signals to go short or signals to go long. This is all about educating yourself. This is all about you being a business owner and being familiar enough with your business to know what decisions to make. If you owned a manufacturing business, you're not blind or ignorant to what's going on the shop floor, but it doesn't mean that you're necessarily the one doing all the work. It just means that you're looking for those things that are going to tell you whether your manufacturing business is humming along nicely, whether orders are getting built correctly, shipped to your clients appropriately, and you're receiving revenue from it. There are going to be failure points. There are going to be points where you recognize that there's something amiss in the process, and that correlates to trading as a business. There are going to be things that look like they're not quite right. What do you do in those situations? You sit back and you wait for them to adjust themselves until you recognize that the pattern is more opportune for you to get started into a new trade. So I just really wanted to emphasize risk. I talk about risk a lot because in my experience, having literally worked with thousands of traders over the years, that is the biggest problem that traders create for themselves. And it's the biggest reason why a trader who comes to trading very enthusiastic and very excited about learning how to trade and about wanting to make money and perhaps build their own lifestyle freedom and financial security, why they fizzle out and they leave lacking the success that they originally desired. There's absolutely no reason for that to occur. To be successful, you have to be disciplined. And the first and foremost part of discipline is managing your risk. So you will continue to hear me talk about risk on a regular basis. We'll talk about other topics on these live trading room mid-market summaries. But risk is something that just is, I'm so sensitive to risk. It's so important. I'm very sensitive to it because I work with so many traders, and I see those traders who will communicate with me and celebrate their wins and how they learned how to manage this trade, and they were wise about managing their capital and never put themselves at risk, and they got out of a very difficult situation overall with a profit, even though they originally had a drawdown. It's those types of scenarios. And then I contrast those scenarios with people I hear from who they push themselves right up against the wall. They overextended the number of contracts that they should have been trading, and they overextended their capital. And there's no easy way out on that. There's no easy answer. And those are the people that I worry about because they can't necessarily wiggle their way out of a situation because they've run out of capital. And I would sincerely enjoy seeing everybody who has a desire and passion for trading to be successful. And as I mentioned yesterday, trading, in my opinion, is one of the absolute best opportunities to create wealth. It's one of the best opportunities to create your own business where you are an independent business owner of your trading business, but you don't have the burden of employees and overhead and inventory and leases and fixtures and furniture and all of those types of things. So that's it for me today. I do sincerely appreciate you being here, and I hope all of you manage your risk intelligently. We talk about it a lot, we being Michael and Aaron and Allison, my trading team, and Options Moneymaker. We have a desire for you to be successful. We're here to help you as much as we can, and let's go make some money. If you just make $400 a day, which could literally be 1 to 2 trades, you can make $96,000 a year if you average $400 a day. Now, you might not make $400 every single day, but if you can average about $400 a day, you can do very well. Our year-to-date average is right around $2,400 a day. One last thing I'll share with you. Donald, one of our longtime members of our live trading room and longtime client of Options Moneymaker, shared with me today that he's actually been trading less than what he would normally be trading. He's had some family obligations, and yet he wanted to share that he was making just under $400 a day average per trading day since the beginning of the year. So when you're averaging $400 a day of profit, 400 might not sound like a lot, but when you're recycling your capital over and over, and you're using the same capital to enter new trades each time, the same capital recycled, and you can potentially earn as much as $96,000 over the course of 12 months, recycling that same capital. To me, that's a very, very powerful business proposition. Very powerful business proposition. Okay, we're going to get focused back on our Able Trend charts. I see some sell signals coming on RUT. Might be breaking below 3-minute support on SPX and NDX, so might have opportunity to take a trade here.